So I just had a really fun conversation with a client who was really concerned about the status of the economy right now, with the status of the world's reserve currency for the US dollar, with the unfunded liabilities, with the central banking digital currency, the CBDC coming out, all these concerns that are going on in the world, things that are being overly sensationalized, I believe, in the media. And their question to me was, Chris, is now really a good time to put money into a whole life insurance policy with everything that's going on in the world, or is there just too much risk and too much uncertainty? I want to share with you kind of the process that I brought her through and the conversation that we had, because I think it'll make a lot of sense and it'll show you why I have so much confidence in whole life insurance right now. So let's get into it. If you haven't already, make sure you subscribe and hit the bell. That way you're notified every time I launch a new video. Let's go. Hey, what's going on, Cashflow hackers? It's Chris with Life 180, and today's gonna be a fun video. We're gonna be talking about the world's reserve currency status that we have for the US dollar, what's going on with it. Is life insurance a good place to keep your money? We're gonna be getting into all this and figure out if you think it would be right for you. I get hit up with questions every single day about what's going on with the dollar, what's going on with the CBDC, what's going on with life insurance, like what's a good place to save, how's it gonna impact our real estate investments, like all this different stuff. And so what I wanna do is I wanna share in this a little bit of history, because I'm a big believer that history has a habit of repeating itself. And when you look at the foundational elements of kind of the development of the currency in the United States, and you look at how banks have reacted, and then you look at the life insurance companies, the participating mutually held life insurance companies that have been around and operating since 1842, through all this chaos, through all this crisis, through all these things that go and have come and gone in the economy. Well, the one type of financial institution that's weathered every single storm is the participating mutually held life insurance company. And so when you look at that and you start to realize, you see patterns in this, and you realize, wow, during this time of history, these are the companies that, because of their model of business, because of the fact that they've never participated in fractional reserve banking, it's actually, this is why I came up with this idea the other day that infinite banking is actually sound banking. That's it. Fractional reserve banking is too much leverage, which leads to all these problems in our economic basis. It's why all these banks fail. They take on too much leverage and they get outside of their real role and duty as a bank, which is creating a means of transactions. Now, don't get me wrong, banks make a lot of money on both sides for those transactions, but what's happened is they've even amplified the problem, and they've kind of gotten into the world of speculation, right? And with the fractional reserve banking and the reduction of the reserve requirements for banks, it makes it so very small drops in liquidity in a bank can cause a run on the bank and cause liquidity crisis, and that can cause banks to fail. And that's what we're looking, with the Silicon Valley Bank and other banks. And that's why I think a lot of banks are at risk right now. Once again, I don't want to overly sensationalize that, but it's what's going on in the world right now. It's things that we have to consider. In 2008, over 560 banks failed. Think about that, 560 banks. Since 1842, one participating mutually held life insurance companies failed. That's it. And so I want to get into this and just kind of talk about the history here. And I want to get through this. So if we look at the history of the US dollar right here, and we look at the history of the US dollar, and we look at whole life insurance, and what I want to do is a little bit of a history app, because I'm totally a nerd like this, right? So we look at 1842 was the institution, the first participating mutually held life insurance company. So when people ask me, Chris, should I put my money into a properly designed whole life insurance contract, and why would I do that? What does the flow of that money look like? Where does my money go? What happens to it? Simply put, your money goes into the life insurance company, they put it in their general fund, and then they invest it how they see fit according to the rules and regulations of that life insurance companies have to manage their money inside of their general funds. Now, almost all these general funds, I don't care if you're talking about the big major 4 life insurance companies or some of the mid-major sort of companies we're talking about, they all operate kind of with the same rules, right? And that's important to understand. And sometimes that's one of the reasons I prefer the smaller companies, is because the bigger companies are kind of like the Titanic. Their general funds are so big that it's hard for them to pivot, whereas smaller companies can pivot much quicker. And a lot of people seem to have this affinity to want to be with a big company like a Mass Mutual and like a Guardian and like a Penn Mutual and New York Life and Northwestern Mutual. And listen, I'm not saying these companies are bad. They're all good. It's like it's fine. But I personally like to be with a company that's a bit more nimble, right? That's why my personal, deals are not going to those companies, and that just is what it is. I understand that some people want to go with bigger companies, and some people with monstrous policies and higher net worths need to go with organizations like that. But I would really encourage everybody to open their mind a little bit with the type of company that you're working with. Now, that's kind of a side note. Now, on the next level here, what I would say is, like, when we put our money into the general fund, what's happening is our money is going into that account, and we're basically giving permission to the company, and we're basically saying, hey, listen, I want you to manage the risk for my safe money. I can put my money in a bank account, and I could manage the risk of inflation and all the things that go with a savings account, because you're not going to beat inflation. You're going to lose purchasing power. The gain of liquidity of that savings account is negated by the reduction of purchasing power of that money over time through inflation, which obviously I've done a lot of videos on this. But at the end of the day, when you give your money to a life insurance company, a lot of people say, well, life insurance is a horrible investment. Well, yeah, life insurance is a horrible investment. Life insurance is not an investment. Life insurance is a savings alternative to a savings account. It's going to give you savings-like liquidity with returns that over the long haul are going to beat inflation. So life insurance companies do one thing and one thing well. They maintain the purchasing power of your money. So it's not sexy. It's not going to get you big, bold, amazing returns, but it is going to keep liquidity of your money, and it's going to beat inflation over that period of time. So it's kind of, if you believe that you need safe, liquid, accessible capital, and that liquidity is important to you, like, think about your real estate investors, think about your entrepreneurs, your business owners, people that need access to capital. That's where the power of infinite banking comes in. And taking control of the banking function of your life. And I know that's a phrase that a lot of infinite banking people like to use, and talking about, like, stop giving the bank all your money on the transactions and keep it inside of your own financial ecosystem. That's getting to the second level. I've got other videos on that topic. We're not going to go super deep into that in this video, but this video, what I think is really important, when people ask me, Chris, why do you want to put your money into a bank? Well, it's because into a life insurance company instead of a bank, it's because when I put my money there, I know they're going to manage that risk. And when I go through the history here, I think you're going to understand what I mean by that and why I feel so strongly on this. So let's talk about this. 1842, life insurance companies, participating mutually held life insurance companies were created, right? And so now I want to talk about the banking system and the versions of the dollar, because right now we're down here, and a lot of people are worried about the big old bad CBDC, the loss of the world's reserve currency standard status for the United States and the world, and what will the impending impact on that be? I will tell you, I'm a big believer that during my lifetime, we will lose the world's reserve currency status, that there will be some sort of CBDC. I know it's already in play. Jerome Powell's already starting that run. Am I gonna sensationalize that and create videos that are scaring the crap out of people? No, I'm not gonna do that, because I don't believe it's that big of a deal if you handle. And I think when you look at this through the lens of history has a habit of repeating itself, this is just the next natural progression in the economy, in the way that money works. And yes, there's elements of it that are pretty scary when you look at it from the fact that we're going digital and there's a lack of control, and that the government has the ability to kind of control you with this stuff. But that's like another like layer to this. What I think is important to look at is, like, look at the history here. I want to go through this just history real quick. 1837 to 1862. So I started here because life insurance companies started in 1842, and this is really important to understand. So from 1837 to 1862 was known as the free banking era. There were no real regulations here. There was a lot of money. A lot of things were done state by state. Notes were printed. Money was put into circulation, money was taken out of circulation, but there were wild swings in inflation and deflation, and it was a little bit out of control. This free banking era and lack of regulation created all sorts of issues. But during that time, life insurance companies, even in their infancy, still endured because of the way that they invested in their sound money strategies. They got through it. Now, if anybody remembers history, 1862, it was about 1861, the Civil War happened, right? And so when the Civil War happened, there was all sorts of debt. They had to print a lot of money to handle that debt. Greenbacks were printed. If anybody's ever heard that phrase, that the greenbacks were actually created in the 1861 timeframe to deal with that. So in 1863, the National Bank Act was created. And the goal of this National Bank Act was to create a uniform national currency and to create some stability to hopefully like flatten the curve of inflation and deflation and like the massive volatility that was happening. They wanted to create one national currency that would be a national banking system that would control things and create a little more stability. That worked. From 1863 to 1913, it was definitely better than 1837 to 1862. But if you recall, in the 1890s, in 1907, and then I guess 1907, there were some challenges, and then the Federal Reserve Act was passed in 1913. The Federal Reserve was instituted, right? And that's what we have here. So when you look at this, we had since 1842, when life insurance companies started acting, we have one currency, we have two currencies, and we have three currency transitions. And now if you want to go even further, I would say the Federal Reserve Act was in place. Now this just simply shifted power because there's nothing federal about the Federal Reserve. It is a private bank of cronies, I believe, that are running this, and they've somehow tricked people into putting their money into this system that they control. All the while, banks and major corporations own more properly designed whole life insurance than the rest of people combined. So banks somehow convinced you, give your money to them, they're going to take their money and put it back into whole life insurance. And the wealthiest people that were the founders of these banks still had their money in whole life insurance, yet they convinced you the best place for you to put your money was in the bank and not the life insurance company. That's neither here nor there. There's a great book here called written by G. Edward Griffin, and it's called The Creatures from Jekyll Island. And it's an amazing book. I would encourage everybody to read it. Now, here's the deal. This isn't a change in the Federal Reserve. It's still the same dollar, but it's important to note that in the Federal Reserve Act, we had a gold standard, right? Everything was backed by gold. And so we had gold and silver notes. And so I'll put the fourth currency was 1944 when the Bretton Woods Act was made. And that's what actually made us a world's reserve currency, because we had more gold reserves than anybody else in the world. So we went and became this the world's reserve currency because of our financial stability and all the gold that we had in Fort Knox, right? And now we don't have any gold in Fort Knox, is the rumor on the street. I haven't been there, I haven't seen it, but that is what it is. But then what happens is, what do we have? We went through, we had the wars, we had the Korean War, we had the Vietnam War. And so in 1971, because of all the money printing, because of all the things that we had, we were actually going bankrupt. We didn't have enough gold to back all the money that we printed. So Richard Nixon in April of 1971 removed us from the gold standard. And so that is a challenge. Everybody's freaking out about the CBDC right now. I would argue we went through the worst of it in 1971 when we went off the gold standard, and we basically eliminated the governor that reduced our government's ability and the Federal Reserve's ability to just print money, right? Like that is what it is. And so, the fact that we're talking about the CBDC right now, everybody's freaking out about it. And we talk about, is a life insurance company a good place to keep your money? Well, I go and I say, all right, well, if you want to be successful, find people who are successful and emulate what they do. And I look at banks, I look at corporations, I look at politicians, and I think if you look at the leaders of these places, these three things, and if you were to look at the leaders of these things, and most people would look at that from at least a financial perspective, not talking about how they live their life and how happy they are and all that stuff, but just pure money perspective. These are some of the most successful people in the world, the elite of the elite, if you will, right? I hate using these catchphrases because it's very clickbaity and it drives me nuts, but it is what it is. These guys, the CEOs, the leaders of the biggest corporations and the Fortune 500 and the politicians. Barry Dyke did a thing that showed 54 congressmen, women, the former chairman of the Federal Reserve, all use life insurance products as a big foundational asset component of their financial house, right? And so when you look at it like that, 54 politicians that have been confirmed, corporations and banks, all those own more life insurance than everybody else combined in the world, right? So when we look at that, I go, all right, why would they do that? Why would all the banks have their money in life insurance companies? There's a thing that, I think it was Bank of America, I read this thing that said they have more money in whole life insurance than they own in real estate, right? So they're tier one capital reserves are held more in life insurance than any other asset that they have. And so when you think about it like that, why are they doing that? And I go, okay, why are they doing it? Why are corporations doing it for all their key executives, for not all, but for a lot of their key executives and for a lot of their operational capital that they have on the back end that they can control and leverage in a lot of different ways? Why are politicians who are in the know, why are they doing this? Why are they leaning on these mutually held life insurance companies to do this? So that's the question. When I look at that and I go, well, because they know life insurance companies have been doing this since 1842. Life insurance companies have weathered this entire storm. Life insurance companies have, in 2008, when 560 banks failed, not one failed. In 1929, when the Great Depression happened, not one mutually held life insurance company failed. I had Harry Dent on the channel one time, and he was talking about life insurance companies. Not only did they not fail, they were the only companies to make money during those times. And you can't understate the value in that and the stability in that, and the fact that when you utilize whole life insurance as your bank, what you're actually doing is you're taking over the banking function in your life because it gives you so much flexibility, but you're actually implementing sound banking in a way that other banks don't do. And now there are some banks out there that do implement a better, more sound banking, and they don't really play into the whole fractional reserve banking system scheme the way that a lot of people do, or a lot of banks do. But the bottom line is, when I look at this, I say, okay, if these guys are keeping their money there, and they're not worried about this transition of the loss of the WRC, the world's reserve currency, if they're not worried about the CBDC and like all these things are going on, my belief is life insurance companies weathered every one of these transitions, every one of these storms. They know how to navigate it. They never lose money. They never fail. They never do it. They haven't to this point in time. That's 180 years of history. So I could keep my money in a bank. I could keep my money other places. I could do all this stuff, or I could put my money in a whole life insurance policy. And by putting my money in a whole life insurance policy, what I'm doing is I'm saying, listen, insurance company, general fund managers, I'm trusting you with my money because this is what you've done for 180 years. You manage this risk, you manage this flow, and I trust that you're gonna manage it at this point in time. And if you have all these bankers and all these corporations and all these politicians, their money there, you're not gonna let them fail. So I wanna put my money in a place where their money is, because if they're not gonna fail, I'm not gonna fail at the end of the day, because I know that's the case because there's no fractional reserve banking instituted in the insurance companies when it comes time where, if in fact we are going to lose the world's reserve currency, if in fact the CBDC comes into play, and that changes the dynamic and the effect of like where the best investments are and what kind of hedging you need to do and all this stuff, I could try to manage that, and I'm a pretty smart guy, but like, I'm not going to beat these guys, and they're dealing with billions of dollars, and their scale is just beyond anything that most individuals outside of maybe 2 or 3 people in the world have the ability to do. So I'm basically giving that to them, trusting that because they have this track record of success, because of the fact that they've done this for 180 years and they've done it without fail successfully, they've never missed dividend payments. We only work with companies that do that, and this is why I'm so passionate about doing this. This is why a lot of the people in the world are freaking out, and I'm just sitting here going like, no, these guys are gonna manage this transition. It's natural to think you're gonna go 100 years. Let's say we live 100 years in this life. To think we're gonna go 100 years without significant transition, you're delusional. And I would argue, like, if you're 80 years old, you know, if you've gone through 1, 2, and now you're going through your 3rd transition in some way, shape, or form. And I guarantee if you were to talk to somebody who's 80 years old and freaking out about the CBDC, and you go back and you talk to them about the Bretton Woods Act, and you talk about the 1971 and the elimination of the gold standard, they're gonna be like, yeah, we've been here, done this, seen this. It's not anything to be, yeah, it sucks, but it's not like the end of the world. People are gonna get through it, right? And so I'm telling you, like, this is why when I tell people, I believe every single person with safe, liquid, accessible capital should put their money out of a bank into a properly designed whole life insurance policy. This is why. Now, I'm a big believer you got to align your money with your values and beliefs. So if you don't believe in all this, if you're not worried about the debt, if you're not worried about the unfunded liabilities, if you're not worried about inflation, if you're not worried about the CBDC, if you're not worried about losing the world's reserve currency, then you can ignore everything I just said. If you are concerned about those things, I would say, don't freak out. This is a solution, and that is it. So hopefully you found value in this. If you did, please like, share the video. Have a blessed, inspirational day. We'll see you on the next video. Take care.